Another Learning About Loans with the only JW Justin Wood. My man, we were just chatting actually earlier today, full disclosure, Justin and I were chatting. We were talking about a program we have and just I think it's worth bringing up. So sometimes we come into this where I don't know anything. Today, it's not that it's premeditated, but the topic warranted this unscheduled program for us. So Justin, what is the topic of the day? What are we talking about?
Yep, today we are talking about a home equity line of credit or a HELOC now available here in Texas for us with our company.
Love it. So we've had options to do these. Oftentimes we would send them out to banks and other places we know that just for what we had then compared to now, we knew the banks were better fits. And we still do, even though we have this new product, we still do. So what is it now? Why are we making this thing? If all we do is send business out, why do we even do this video? The reality is we don't send everybody out. And so that's what we want to focus on today is when do we think what we have is a good fit. So let's talk about a HELOC. We won't go into too many details. It's a line of credit that's tied to your house. We got plenty of other videos and other places somebody can go look at. But why do we like this HELOC so much? I think we call it the Flex HELOC. Is that correct? That's the name of it?
That's right. And why we like this HELOC so much, Mark, is because, and I know we get a bunch of these calls, right? We have somebody who wants to buy a new home, but a lot of their equity down payment is tied with their current home. Not to mention, they don't want to wait on the approval for the bank HELOC that can take 30, 45 days to get done. So the benefit of this is speed, convenience, and keeping it all in-house for a one-stop shop for both your HELOC and your new purchase opportunity with us.
That's right. So in other words, Joe buyer, somebody wants to buy the home, calls us, but in order to qualify to for money for a down payment, Joe's got a ton of money sitting in his current home. So the solution here is it's an opportunity for us to say, look, we can get the equity or at least some of the equity out of your current home and use that for the down payment on the new home. So Justin, you talked about the timelines, about one of the advantages you mentioned two or three. So let's jump into those deeper. The timeline you mentioned, it can take. We've seen it, man. Back in the day, we've seen it take literally 2 months, 3 months. That's more COVID era. I would say your timeline you gave is accurate, right? It's about 30 to 45 days for banks, maybe sometimes 3 weeks, but for the most part, about 30 to 45 days. What's the timeline now that we have with what we do with the Flex HELOC?
With the Flex HELOC, you can actually close these products in a week, right? So you get your money quickly. It does incorporate some AIs, a lot of automated systems, may or may not need an appraisal. You can do everything right in the portal, and you usually get your offer within a matter of minutes, and you can choose what you want to do versus waiting to go back and forth and get your options.
Dang. So, and I know this is true, but every time I hear it, so it's crazy. So, one, your approval is done within hours, minutes. You said an hour or two, same day, basically, for sure, right?
Right. Yep. And if you can incorporate a lot of the third-party verifications that we already use as a lender, right? Things like the work number and stuff like that for the income pieces, AVM appraisals, right? If the system works and you plug it in correctly, yes, you can get your money very quickly with this
So
product.
let's use an example. And I'm going to throw the disclaimer out there. I don't know if Lockheed's I think they are, but that's why I don't mind using them. But let's say somebody lives in Fort Worth, the heart of Fort Worth, you know, a lot of homes being bought and sold in there. So there's good market, the market's known. It's not like you're buying out in West Texas where one home sells every 3 months. But you're in Fort Worth, you work for Lockheed Martin, major big company, defense contractor. So all the stuff's available. They got all the systems for verification of like verification of employment, verification of income, and they bank with Bank of America. We're all there. It's big bank. They got all the systems and tools. What you're saying and what I'm hearing you say, that person with good credit can come in here and just couple clicks of a button, all that stuff talks to each other with the systems and what we do to where the underwriting process becomes like it should in a perfect world, very quick, and they can be approved within hour, 2 hours, and then they can actually fund and close and get the money within the week or so, give or take. So a few business
Right.
days compared to a few business weeks. So that to me is huge. What if you're not that guy? What if you don't live in the middle of the metropolitan city? You're on the outskirts, you're out somewhere else, and you're self-employed. You got tax returns that are, you got to look at them. You got to dive deeper in them. And you use local bank that's been around since, 18 diggity two. And, there's only one bank location. Can that person still apply for these flex HELOCs?
Absolutely. And the only thing is similar to the mortgage process, right? We just say, how quickly can we close, right? Well, how quickly get your documents and paperwork in, right? The consumer will still have access to pull all these things. And the system will still do the secondary checks automatically, right? Credit, of course, address, ATMs, things like that. And then ultimately, once the paperwork is in, it'll run it through the software as well concurrently and then determine, hey, do we qualify or not qualify based on what we provided.
So the difference between the two is not necessarily speed in the process. It's going to be speed in the borrower. So how
Mhm.
fast can Joe borrow, or whether Joe lives in, the middle of the city or out in West Texas, self-employed W-2 doesn't matter. The W-2 guy, the middle of the city guy, just has to do less work because it's all there, it's automated. But you're saying if West Texas Billy is super organized and within 30 minutes he can upload that bank statement, he can upload those tax returns. Is it still just that quick? I mean, obviously it's a little slower, I assume. I don't know. That's what I'm asking you. Is it close to being that quick, or what's is it? I mean, we're talking hours, days difference. What's that look like for West Texas Billy uploading all this stuff?
Yeah, I mean, if West Texas Billy's got great internet and got all his paperwork as a PDF right there, great, no problem. Checking the boxes, West Texas Billy or whoever lives in, the bigger city metropolitan area, they'll still have a credit score, right? They'll still know what their home is worth and they'll still know what their address is too. So ultimately, if they've got that paperwork readily available, might add a couple of days, might add a week, depending on the timeline. But the takeaway is that in either scenario, it's really going to come down to just getting all your information in as soon as possible. And it's still probably going to be faster than the local bank can do it, right? Within a
I,
30
I
day.
would tell you for sure, and especially if West Texas Billy's going to West Texas Bank.
Mm-hmm.
What I can tell you, and yes, it's a stereotype, but the reality is they don't move on as fast as normal some of the the bigger city banks, if you want to use that air quotes. All right, so speed and ease. Those two things are by far the biggest advantage of this Flex HELOC that we're working with, and that allows again people to tap the equity in their home very quickly. We're seeing this a lot when somebody needs to get the equity out of their home to then buy a new home, like a bridge loan, in essence, like a bridge loan. What are the
Right.
downfalls? You and I know this. We've talked about it before. What would be okay if everything sounds great? What's the catch? And
Yeah.
I don't want to say downfalls, but let's say what's the trade-off? That's probably the better word. I'm getting something super easy. I'm getting something
Mm-hmm.
super quick. What's my trade-off?
Yeah, trade-off is some banks, they don't require you to take an initial draw at closing, right? We do. So when you originate a second lien HELOC with our team, you're required to advance a minimum of 75% from the date it's open. So if you got a $100,000 loan amount, you have to take that draw of 75 grand up front. Now, the second catch is the fees. It's a flat 2% fee. So that is the other trade-off as well. It is a 2% cost, which I know we'll talk about why that still may be more beneficial than a bridge loan. But yeah, that there is a cost up front on that too.
And that's just to be clear on Justin's example, the $100,000 line of credit. The reason why it's a downfall, if somebody's going to take 75, you may be thinking, well, that doesn't sound like that big of a downfall. Some folks like to get a line of credit and just have it to have it, and I do like that for them. By the way, it's a great safety blanket. And with no payment or no balance, that means no payment. So if we make you at the time of closing take the 75, that means you're at least gonna have to make one payment at the $75,000 balance. Now, ultimately, you can pay it off you can put it back down to zero afterwards, but that's at least one little piece. The 2 points that does explain that more, and let's talk about what that looks like into comparing other bridge loans. Two to the normal consumer may say, man, on a $75,000 loan, 1,500 bucks. It's not a lot. It's not cheap, but it's not a lot. So, how
Right.
does that stack up to normal HELOCs, and why, in this instance, does that seem to be somewhat normal? Tell me kind of I think you know where I'm going with this, but how does that stack up? Let's start with how does that stack up to normal, air quotes, normal HELOCs that are out there?
Yeah, normal HELOCs that are out there, generally their fees are going to be lower because they're a bank securitized, right? They're the ones originating the money. It's their money. It's their line of credit given to you by attaching a lien to your property. So in the other piece of that too is sometimes traditional bridge loans, depending on the new home, existing home, where the current home is at, where the new home is at, right? Those fees can vary. I've seen upwards sometimes up to 3%, whether it's on the old home, whether it's on the new home. Maybe they cut your agent out of the new bit, whatever it might be. There's just a lot of different nuances for bridge loans, and that sometimes they're great and sometimes they're not. But ultimately, this is just the same continuance peace of mind. That's the fee, regardless going forward.
Yep, you nailed it, buddy. So just to restate it to make sure everybody understands, for a quote unquote normal HELOC, like, hey, I'm just gonna go get it. Absolutely, full disclosure, banks most of the times, a lot of the ones we refer charge 0 points. It's like, well, dang, that's a $1,500 swing. It is, you're right, which is why we do refer out a lot of business. when it
Right.
makes sense for somebody to do that. But if you just got a 30-day contract to close on a home and you need this bridge loan, we don't have 30 days or 4 to 6 weeks to wait for said bank to get you access to those funds. So that's why this product again goes back to the ease and the speed of getting it done. The trade-off is yes, there's 2 points, but here's the catch. When folks go get a HELOC from even the banks we recommend, if it's a bridge loan, meaning something that's just there until that home sells, more often than not, they're gonna charge potentially 2 points. To your point, Justin, sometimes three. I've seen anything from 1 to 3 when they know it's a bridge loan, when they know they're gonna get paid off pretty quick because they don't have time to make interest, right? If you only have a loan for
Right.
3 months, they're not making any money. So
Right.
the 2 points is really kind of, if you use it for a bridge loan, so competitive. Rate, we're not going to get into. Reason being is, again, if we're talking a bridge loan, you're selling that second home typically, or the existing home eventually. So even if rates 8% versus 6, at the end of the day, 1 or 2 payments not going to kill you. If it was over the course of 30 years, absolutely, but it's not that big a
Right.
deal. So
And on the index too, while you're on that, so with these loans, they're all 5-year interest only draw period, right? So let's say it goes beyond that timeline. And then once it's done, they'll be locked on a 25-year note and then repaid over the 25-year during that time. So interest only, that's super important. And a lot of what I want to highlight with this product as far as the speed, some people don't need the down payment. They need money to pay off existing debts, right? From a DTI standpoint. That's a
mm,
nice piece of this too, is that you can use the proceeds to pay off, credit cards that are in 20, 25%. I saw a personal loan on some consumer's credit the other day that was a 22% interest rate, right? And even still, these loans, these products we're offering with the Nifty Door, or the Flex HELOC, whatever you want to call it, can go down to a 640, right? So ultimately, the consumers that really need help now consolidate all that debt, start fresh with the new, why not, right? As far as the
yeah,
next
and
step.
that's two really good points. One is one, I agree with you, right? The paying off the debt, like it's not necessarily, the old adage, it's not your interest rate, it's your interest payments. If you're paying off a 22% debt over here, and this allows you to accelerate and get this one paid off at whatever percent it's going to be, that's huge. But I think what you just said, I forgot about. You were right. 640 credit score, that's really low in a good way, right? Most banks are going to have, they're going to have elevated their higher requirements for credit. And so sometimes it may be that we do send them somewhere and they come back because the banks can't or won't do them. So this is a great product. And my recommendation with this product, because it is so fast, it is so easy, that it does make sense to say, let's just see what the terms are, get it done, see what your terms are. Then all of us can assess whether or not this is going to work for them after we then reach out to our other banks to figure out what they got. So I think it's a phenomenal product. Um, at the end of the day, again, we're smart enough. And again, Justin, you and I have worked together long enough, and people that know us know this. At the end of the day, we're not worried about getting a loan, right? We want to take care of the customer, the client, do what's right for them and their families, and we will help navigate whether this fits because we both agree this is a great and wonderful product when it fits. There are
Mhm.
many instances where this won't be the right product for somebody, but quick, easy, short term. Um, maybe it's the only one they can get from a credit standpoint. This is a really good product. Any last comments or thoughts before we part ways on this topic?
Yeah, I will just add that, if, a lot of the times before, right, before having to go to, bank or call lender X or Y or Z, right, to kind of piece all this together, ultimately, this keeps it under one umbrella with our team. We can originate your new purchase transaction, whether it's primary, second home, investment property, whatever it is, keeps it all in house, and you're not having to send documents to 4 or 5 different people, right? It's one stop, one shop, and we set it up and copy it all over and keep it moving.
And that's more valuable than people may understand. So again, if somebody is buying a home to keep it here with us, knowing that we're on it, we do it because you and I have had that heartburn where that third party bank and we have referred them, right? So it's not our fault, but it is certainly
Right.
we feel a little responsibility. When they don't do their part as quick as we do, it can create that heartburn and stress, and it's just not ideal. So that's a really good point to make. But
Yep.
Justin, buddy, love you. You're always great and amazing. For joining on another learning about loans.